That's good. All right. Hello, everybody. Welcome back to another episode of Palantir Weekly. I think this is episode number 99. So we're one away from Magic 100. Today I've got with me Mr. Vince's Bullish, who is up at 5 a.m. his time talking to us about the world of Palantir. We got Arnie from Italy, I think also 5 a.m. or in your world, Arnie. And we got Steve, who's on the East Coast with me, 11 p.m. Eastern Standard Time, talking about Palantir because we're so excited to talk about it. Right, Steve?
Ecstatic.
Steve, I have a question for you.
Oh, God. Here we go.
So remember when I wanted you to come to Las Vegas with me?
I remember when you wanted me to come to Las Vegas with you.
Okay. And do you remember the reason you couldn't come to Las Vegas with me?
Yeah, because it's insurance season.
Right. And you had work, correct?
Yes.
Okay. You have no idea where this is going, which is why.
No, I know where this is going because I said I took yesterday off. I know.
Correct. You took yesterday off. Hold on. Let me talk. Let me talk.
No.
Just let me get this off my chest.
What month is it? It's November.
It's
I said my business season is September through October.
Let me just make it clear to the 54 people that are here. This man took a day off to finish a Palantir Seeking Alpha article.
No. That's not why.
But he wouldn't take a day off to come hang out with me on my 26th birthday in Vegas.
Okay. You know what? I am on the board of my building. I had my annual shareholder meeting last night and our board meeting last night. I took the day off, and in the morning, I wrote a Palantir article, and the rest of the day I was doing financials and preparing for the annual shareholder meeting. And
Steve, my point is,
the
text I got from you is
do not lie. I told you my busy season is the middle of September to the end of October. Did I not?
Steve, I get a text yesterday, 11:48.
Is that not what I said to you?
Yeah, I don't know what you said. Took the day off. I'm 1,900 words in, baby. Let's effing go. And you didn't spell effing.
I wrote it in the morning.
All right. I just want to say that Steve took time out of his life to finish a Palantir article, but he wouldn't take time out of his life to hang out with me. That's all I want to say. It shows your dedication to Palantir. That's for sure.
It went up a lot today. It went up a lot.
It did go up a lot today, which is why we have a second part to the introduction of the podcast. Ladies and gentlemen, Palantir's up 7% today. 1960, I think it ended. I've been drinking hot sauce all day. This Palantir's been red hot. So you know what I'm about to do live on this podcast? My mom made some banana chocolate chip bread, okay? And I'm going to put some hot sauce on this bread because that's how hot Palantir has been, okay? So we're about to... I love hot sauce. I love my mom's banana nut bread. Matt, you're here right in time. This is actual dedication to Palantir, Steve. You eat some hot sauce because it's hot, not you take a day off and you finish an article. All right, ready?
Frank's Red Hot is delicious. Congratulations.
I mean, it's on banana nut chocolate bread. So, not gonna lie, this is probably
banana nut chocolate. That's a good one.
That's a lot of hot sauce, folks. That's a lot.
It's not enough, dude. I'll drink that.
Not enough.
It's not enough.
Palantir is hotter than that.
No, we'll go even crazier. I'm not playing around. Palantir was up 7% today, ladies.
I've been waiting.
Is that a 7%?
There we go.
I think a 7% deserves more.
To come and
all right, here we go. 3. I'm gonna eat the whole thing. Ready?
Oh my god.
Yeah. Talk to me, Daddy.
Can you just link the article that I put in the private chat in the comments section? It won't let me do it.
Oh, the article that you took.
We gotta give our guy a wrench, my guy.
That's true.
What's up, man?
All right.
How are you guys, man?
Arnie, next time just get your Christmas tree out like me to celebrate. It's much nicer.
It actually wasn't that bad. All right, ladies and gentlemen, let's actually start the podcast. We're all here. Let's go around the table. Raw thoughts of the price action today. Then we'll get deep into Steve's article, Arnie's DCF. We got a ton of stuff to talk about. Vince, what was your reaction to the price action today?
I mean, I loved it. We are quite richly valued, I think, but I take it. I have a gut feeling that Palantir is going over 20 and is staying there. It's not based on any valuation. I just don't see any bad news coming Palantir's way, and it feels like there's just good news that keep coming our way. So I'm gladly taking it.
Sorry, I was drinking some lemonade. Okay, cool. Arnie, your thoughts on the price action today?
Well, you needed to enjoy with a hot sauce. I'm actually doing the opposite. I'm having a relax herbal tea so that I'm calmed down.
Okay.
And
That's not
I
too
try
bad.
to stay quite rational. And what about the price action? Well, this makes me think of we actually had the opportunity to front run Wall Street, and I realized it just later because it could be possible that this price action that was quite mad happened as the rumors that we spotted early yesterday about the NHS deal actually getting through is what is moving the price. Now, we don't really know because there is no official press release. On Bloomberg, there is nothing official, but it is possible that what we discovered actually helped.
Okay. Matt, your raw thoughts on the price action today?
I mean, I think it's warranted. You think about it; it's a $500 million deal at a minimum. Over 4 to 5 years, it's going to add about 4% to the revenue stream on an annual basis, kind of going forward. So I think that if you just think about it from that respect, the price action is unwarranted. But when you think about it, it's delivering again on another healthcare system that is going to open up the opportunity for other healthcare systems around the globe. So this, I think, is just the first pawn really to fall. And, maybe the second or third, I guess, if you want to consider Tampa General Hospital and HCA in that sort of realm. But I think they're continuing to dominate in the healthcare space. And I think that people are starting to truly open up and recognize what Hospital 360 is truly going to do and what the FDP is really going to do at the NHS.
Okay, and Mr. Steven, you wrote an article?
Yeah.
Yes, Wall Street read the article?
I don't know who read the article, but
before you go deep into it, what was your thoughts on the price action? Then we'll go deep into your
that's
article.
what I was going to say. Look, the whole market mooned today. I think that the price action is normal considering how much the NASDAQ went up today. And there's a lot of excitement around it. And I wouldn't be surprised if it keeps going. I wouldn't be surprised if people take profits. I'm actually looking at where the option market is. And, this is one of those companies I'm so tempted to sell some cover calls on, but I also don't want to get called away on any of the shares. So I've refrained from doing that. Look, I think I say it every time I come on here that I really do believe this is going to be the most important software company behind Microsoft over the next decade. And the reason I say that is because it's hard to say anybody's going to be more important than Microsoft, considering they have Windows, Office, Azure, Microsoft Dynamics, and all those platforms. But Palantir has so much going for them, and the potential of AIP is so underestimated. I don't think people that don't really follow Palantir that closely understand the potential of what it can do.
Okay. Sounds pretty good. So today was a really exciting day, obviously, for the market and for Palantir. It ran up a lot. 19. Where did it end today? Where did it end? Let me check real quick. Palantir ended 1960. No, 1960.
So close.
It was close, yeah. It was great price action, really, really amazing stuff. So I guess we'll start with this. Let's. So Arnie, you put a reverse DCF. That valuation, I really want to let you go in depth and talk about that because I think it'll help people that are struggling with trying to figure out if it's overvalued or not. Before we get into that, Steve, you put out a great article essentially highlighting that the AI wave can continue higher in 2024. So I'll share the article on my screen, but you can give us a high level overview and then we can go to whatever charts.
Yeah, I'm gonna.
Are you going to share it? Okay, perfect.
Yeah, I'm just going to share it because there's some of the charts in there that I want to go over. And, a lot of people that watch this channel know a bunch of what I'm going to say. But, I compared Palantir to MongoDB, Cloudflare, Snowflake, Datadog, and I threw Amazon and Tesla in there for a very specific reason. And I don't think people really realize what this looks like on a price to free cash flow level. And you look at where Tesla trades. Tesla is trading at 182 times its free cash flow. When you buy shares in a company, you are paying for all that company's future profits. Amazon is trading at 87 times their free cash flow. Now, I did these numbers on Thursday, so this is not representative of today's market caps. But Palantir yesterday was trading at 86 times free cash flow. Is that high for a hyper growth company? Some would say yes, some would say no. But I'm not paying for where the company is today. I'm paying for where I think the company is going to go tomorrow and all the cash that they are going to generate, in my opinion, in the future. And you look at how big Amazon has grown. Amazon's grown to $1.5 trillion. And this is a company that for 20 years, people have always made a bear case saying that it's overvalued. I've made the bear case about Tesla being overvalued, and I've been wrong about it. And I am a Tesla shareholder. I mean, sometimes things trade at elevated valuations, and Palantir could trade much higher over the next couple of years because there could be a lot of investment coming into this. And, you look at a company of what they are, and you look at Palantir's balance sheet, look, they are $3.3 billion in cash with zero debt. They could buy every liability back on the balance sheet, still have like $118, $120 million or so in cash on hand without touching the marketable securities that are in short-term treasury bills. So you're buying a company with no debt that is not leveraged, as a great balance sheet that is profitable and a free cash flow machine that is growing. Like, that's what you're buying today. So you're not buying a levered company. So it becomes, where can that company grow into? So then, look, you look at, I don't know if you guys follow Ted Marbury on LinkedIn, but, he made a post where he said the path to 10 billion looks much less daunting than the path to 1 billion did. And then you look at AIP and everything else. And if you believe they're going to get to 10 billion, which I believe they will, I start looking at, okay, I did a bunch of calculations. I'll show the graph, on a 7% quarter over quarter over the next 6 years, where do they get to? Well, they get to 11 billion in annual revenue. You put a 25% free cash flow margin, that's like 2.7 billion in free cash flow. So it's really interesting. These numbers could be crazy high. They could be conservative. They could be on point. We're never going to know until 2029 occurs. But with everything coming down the pipe, these numbers may not be that crazy. And you start looking at the stock-based compensation continuing to fall, the spread between that and revenue continuing. I mean, stock-based compensation is a percentage of revenue. Unlike other companies that are unprofitable, all the blockheads out there, I mean, they are profitable and SBC keeps coming down. And then it's about customers. This is a company that keeps growing the customers on a commercial basis and a government basis. Every bear
Steve,
case,
but do you think it deserves 42 billion as the valuation based on what you're telling me?
What I'm saying is valuation today, if you were just talking about today and not factoring anything in the future in, it is stretched. But if you're factoring in stuff in the future and where it could go, this is a Tesla or Amazon type company. And I'm buying the company for where it is. I bought shares in the single digits. I bought shares in the teens, and I bought shares in the 20s. So, I mean, if you don't think it's going to go up anymore, then the valuation is stretched. If you think you're going to hold this to 2030 and this is going to be a $100 or $200 billion market cap company, and you're willing to hold it that long, then valuation doesn't really matter at this point. If you think it's going to get there, I mean, I'm looking at these numbers, and the bear case was they're a black box, which they never were a black box because everybody knew they did work with the CIA. Everybody understands that they can't talk about classified information, but the contracts that they have with the government have always been known. You can go on the federal procurement site. And the bear case was that they are not going to grow the customer count on the commercial side. Well, that bear case is eradicated. It's done with. You can't say that bear case anymore, especially with the customers that are presenting at AIPCon and everything else. Like that is done with. And then you look at their deal book and you start looking at the deals over the past year on the 1 million plus, and then the amount of deals in 5 and 10 million. I mean, this is a company that
was a big upgrade in Q3. Yeah.
You know, this is a big deal, a real big deal that they did around 80 deals of $1 million plus. And they're just getting started. Wait till AIP starts being monetized. And then real quick, their free cash flow margin is the thing that gets me really looking at it. You had 2 quarters where the free cash flow margin was over 34%. You had 3 quarters where it was over 20%. So if stock-based compensation comes down and if the margins improve a little bit and you get a 25% free cash flow margin in the future and they are growing revenue by a ton, this is a company that can really do something special. And for the people out there, and I know you debated a bear on YouTube, what I would say is I'm not an expert in AI. I'm not an expert in software. But you know what? Neither are 99.99999% of the people out there. So what I'm going to base my investment thesis on, if Palantir is the real deal or not, is the awards they're winning, which they got voted ranked number 1 artificial intelligence software platform, both in market share and revenue, according to IDC. Most recently ranked number 1 vendor in the 2023 AI, data science, and machine learning wisdom of crowds market study published by Dresner Advisory Services. And they were also recognized as a leader in AI and machine learning software platforms by Forrester. There's other ones that they've done. I didn't put them in this. They're escaping me. I believe Gartner had something on them and some other firms. And then you look at what all the companies from Airbus to Cleveland Clinic to Ferrari to Kinder Morgan to BP to Cisco, what they are doing and what they are presenting at the IP conference. You look at all these customers would not be using Palantir if it wasn't the real deal. And you have 15% of the hospital beds in the US using Palantir software. I mean, for anybody to say that this company is a phony or they don't have good software, right? It's not true. Obviously, these companies are speaking with their wallets, and these are some of the biggest companies in the world. And I think it's a testament to show how significant Palantir is and what they're doing. And this could be just the beginning. So, look, maybe I'm overly bullish, but you look at the use case scenarios that they put on their website with these different companies, the impact studies. You read through them, you watch some of the videos. I think the future looks bright.
No, I agree. Vince, let's get your take on that. And then Arnie, you can pull up your DCF because I want you to go through that and we can talk more about valuation. Any thoughts you have, Vince, on AI being the future and Steve's article writ large?
I mean, I think he's right. This is also why I think that we're going higher, because when you look at historically, when you have these mega secular trends, and we are in a mega secular trend with this AI, normally the companies that are doing well, they always trade expensive throughout the whole cycle. I mean, if you look at Amazon, there has almost never been a time when you could say that this feels undervalued and cheap, and yet you would have made out like a bandit if you invested in it. So I think that the people who are writing these very interesting posts that I'm gonna get into Palantir when the price goes down to 10, it's like, good luck. And I mean, I honestly wish that we go back down there so we can add more, but I just don't think that it's happening. And for me, what is more real is that we're going to go higher from here, and Palantir is always going to trade from very rich to rich. And this is just the reality of things.
Okay. Arnie, you made some news on Twitter today, really discussing this valuation. So you got a fair valuation at $18. Can you walk us through how we got there?
Well, actually, that $18 fair valuation is the starting point, not the output. What typically analysts do and what the financial industry encouraged to do is you have your own assumptions and you plug these assumptions into a model. You make a DCF, and then you compare that output with DCF. The big problem with this is if you are already bullish on the company and you plug assumptions in the model, you probably end up having a very optimistic DCF, because you're intrinsically trying to justify what you are seeing. And we saw that at the extreme in 2020, 2021, when you could see on YouTube even big YouTubers making DCFs with Palantir growing 30%, but the projections were Palantir growing 50% for 10 years. The free cash flow margin was around 20-30, but the expectations, even those DCFs, were like Palantir reaching 50% free cash flow margin. Potentially possible, but you see how dangerous it could be when you're already confident on the company. So why not doing the inverse? Charlie Munger, one of the best investors in the world, says, invert, always invert. And this is exactly what I try to do with this DCF, which is called reverse DCF. So rather than starting from my own assumptions and trying to see how my assumptions relate to the current price, let's start from the current price of $18 per share, and let's go back, so reverse engineer the assumptions that would lead to that price. In other words, we, rather than trying to assess if the current price is good or bad related to my assumptions, let's start to see if the current price actually makes sense given the assumptions that those numbers imply.
Arnie, let me ask you a question real quick. Why do you use a WACC number of 11%?
That I'm going through that. So basically, what we do here is trying to get some assumptions that would make that price justified. And for instance, at an $18 per share, under the assumptions of a WACC of 11% and a terminal growth rate of 3%, basically the price implies that Palantir should grow 30% per 10 years and having a free cash flow margin of 25% for 10 years. And then our job in a reverse DCF is actually asking ourselves, okay, how reasonable are these assumptions? And from this, we can discuss, okay, how reasonable is Palantir could keep growing 30% for 10 years? Because if we see that this number is basically too high compared with what the current price says, compared with what the underlying business structure implies, then we could have a red flag. Same for the free cash flow margin. And where it can be really discussed is on the magic numbers that give you the valuation you want. The WACC, the discount rate, and the terminal growth rate. I put here a WACC of 11% for the simple reason that until Palantir was unprofitable, it was considered an unprofitable trash. Basically, the required rate of return that we should have put was something very high, in the range of 13-15%, because it was basically a venture capital investment type. And venture capital need to invest if their internal rate of return is at least 15%. So I consider it was conservative last year when Palantir was in the middle of a storm, interest rates were rising, to fix a 15% WACC. But now I'm safe at putting that at 11. Why? Because I wrote this article in March, Palantir versus the Wall Street scam, noticing one crucial thing. Basically, Palantir was at $8 per share. All analysts, there were only 2 analysts being positive, 5 on sell and 7 on hold. The price was $8 in March. And I noticed one thing, that there was a discrepancy from how analysts looked at Palantir. They were extremely negative compared with other companies that are around the same cluster, mainly Datadog and Snowflake. And I noticed that even Bank of America, which was very bullish on Palantir, had a discount rate of 13%. Then there was also Morgan Stanley using a 13% discount rate. And to remember, this is one of the key factors that affect the valuation. Basically, you change the valuation, you change this number, the discount rate, for a couple of percentages, and you have a completely different valuation. Here, for instance, the difference between having a discount rate from 13% to 11% just increases the valuation of 30%. This to say, this magic number can change the valuation a lot. But this is exactly what happened. Palantir was valued with a discount rate of 13%, so very penalizing. Yet, on Snowflake and ServiceNow and Datadog, the discount rate was actually way lower. For ServiceNow, I would see a lot of sense because it is more established, it is bigger, it is not only growing very fast with very strong free cash flow margin, but it was also GAAP positive. So ServiceNow having 11%, I would agree with that. Yet Snowflake 11%, Datadog 10%. And so far, neither of the two is actually GAAP positive. And this is a key factor in implying how risky a company is. So what I shared in this article back then is if they are valued with a discount rate of 11%, then I can't see why Palantir couldn't be also valued with that. So basically,
the only reason I ask is because Palantir has no debt, so the cost of debt isn't involved in the WACC formula because it's zero. So I would have thought it would have been, you would have used a little higher of a number.
No, well, look, this is not what I want. Like when I made the reverse DCF, I didn't put what I want, what I imply. I tried to construct what the price currently implies, so that we can reason on, okay, guys, how reasonable it is Palantir grows 30% for 10 years.
Not reasonable.
I mean,
Why not?
10 billion of free cash flow
Why?
10 years from now is
Yeah, I mean, I could see for the next few years 30%, but once you start getting to 2029, you're going to be adding $3 billion in revenue, $4 billion in revenue every single year. I mean, that's assuming a lot, right? I don't think that Palantir has established themselves. I'm a bull, right? And this is coming from me. I mean, why do you think that magically, from what we've seen today, it's going to be able to continue growing at 30% per annum out for the next 10 years? Right. I can understand if we're at where we are today, being able to knock down some big contracts and be able to grow at a 20 to 30% growth rate in the next, say, 4 to 5 years. But once you get to a large enough number, like it's going to get pretty difficult to be able to do that. Where I think that you could have some saving grace with this is I believe free cash flow margin or just cash flow margin in general will be able to grow probably into the mid 30s, closer to the 40% range, just based off of the gross margin is about 80 to 82%. And I think over time, the fact that OpEx is kind of cared for, and I think that Palantir is a prudent operator and they don't add a lot of facetious, headcount and stuff like that. I think that will help save some of what you're kind of going after. But the growth rate, in my opinion, for 30% for 10 years is just a little absurd.
You see,
we know that they can do over 30% in free cash flow on a quarterly basis in some quarters. I think 25% could be conservative. I think they could possibly have a sustainable 30% free cash flow margin. I don't think that that's going to be a problem in a couple of years. I think it's going to be a problem with how aggressive the additional free cash flow on the back half of this is. I mean, that's a lot of additional free cash flow coming in every year.
This is
I would love it because at 10 billion, just trading at 20 times free cash flow where Meta and Google do right now, and they're undervalued in my opinion, puts Palantir at 200 billion market cap.
Well, this is exactly why having a reverse DCF and trying to assess these assumptions is actually more valuable than putting our own assumptions in the model, because basically the current price implies that Palantir should grow 30% for 30 years. And our job is now asking, how reasonable is this assumption? I personally see this assumption potentially possible, but they are already optimistic. Like, we need to be aware that the yardstick is already quite high. Potentially possible, in my opinion, yes, because we are seeing this acceleration that finally, for the first time, it is happening. There are good reasons, in my opinion, factoring in the potential growth from AAP, the healthcare contracts, the NHS, the potential Titan and other JDC2 contracts. So there is a lot of, we say, carne sul fuoco, meaning a lot of stacks currently cooking. Yet, we need to know that at $18 per share, the assumptions implied are already quite optimistic. And the higher the valuation goes, actually, this was done at $18. So now the price is $19. These assumptions should also increase further. So
yeah, I agree with it up to 2029. I mean, my numbers at 7% quarterly are pretty similar from 2024 through 2029. I mean, I think I came out like 11.2 billion. This is at 10.7, but when you go to 2030, that's a 3.2 billion year over year increase on revenue. And then the year over year increases on revenue are so much in those years. I mean,
Yeah,
it's
I agree with you
very
100%, Stephen. Like I
aggressive.
have very similar numbers out to 2026 and maybe slightly lower in 2027 in terms of revenue. But I mean, to assume that it's going to continue at a 30% pace is kind of a little bit.
Oh, if it does, I'm going to be really
Stretch.
freaking happy.
Oh yeah, I'd be happy. I just think that you're looking at and I guess if it depends what you're looking at. Are you looking at how to get to an $18 valuation? Then what this is basically showing is on a P1 case or a likelihood of 1% that it's actually going to be able to match that 30% annual revenue growth out to 2034. Then yeah, you could then say, okay, this $18 valuation or $19 valuation is too expensive. This, to me, though, if you're looking at a probabilistic distribution of what's the likelihood of occurrence, I don't think that Palantir has demonstrated enough. Yes, to have things that have gone in the right direction to make me anticipate that now to 2026, those numbers look rather reasonable. But to be able to continue that pace, I don't think that Palantir has demonstrated enough that, if that were the case and they're going to be able to continue that pace at 30% for the next several years, you're going to have to grow at 60 to 70%. And that number out to 2026 would have to go up by another 50 to 60%. And then it would slow down to a 30%. I just don't see how it's going to stay flat at 30% for that long.
But isn't it even fair to say that it's overvalued at this point based on the way the sector trades? I mean, it's not like Palantir is the outlier here if you look at the price to free cash flow. Snowflake's over 80. It's at 81. Palantir's at 85. Cloudflare's at 175 times free cash flow. And MongoDB is at 591 times. Datadog is the low one at 63. I mean, the whole sector trades at a high price to free cash flow. I mean, Microsoft is over 40 times price to free cash flow.
I think that, I hate to be like, I'm not trying to shit on your shit, right? Because you've done a lot more work on this than I have. But at the same time, the way I'm now looking at this is based off of what Palantir has actually demonstrated in terms of what their software can accomplish, where they are in terms of the ranking, in terms of AI capability as well as software capability, and trying to rank them on a capability perspective, being, are they ranking in the $100 to $200 billion technology company or software company sort of realm, or are they actually leaning towards more what like a Google or Amazon or a Microsoft can do? And I think it's somewhere in the middle, right? So in that respect, but it's going to take a time to get there. It's not going to be instantaneous, and maybe it will. Maybe I'm wrong, and maybe I hope that.
Matt, we're all pretty similar, aren't you and me, on the next couple of years.
For sure. I agree with that. Yeah.
So I would say I'm spot on dead similar with 2029. I think the free cash flow margin is possibly conservative. I mean, I said 25% on a conservative in my stuff. My question is, how do we get to growing revenue by 5 billion annually in that back half? Like that's
10 NHS contracts.
Well, let me show the Excel so that we can make the experiment together.
But by the way, I want to say something sort of controversial, that I think that in the short term, I think Palantir will surprise us on the upside, because if you just look at that they had a sales funnel of running pilots for 6 months with companies, and if you just look at the fact that they're going to have 70 AIP bootcamps in November, which is more than they did all of last year, right? So if we say that their conversion numbers remain the same, which I don't know if you can say, but let's say that the conversion percentage of the customers remains the same, then that should be a more than 12x increase in what they were doing last year, right? But this is when you, let's try to put the pessimistic hat on. So if we say that, okay, something's got to break because that's too good to be true, you could say, okay, but if they're doing that many customers, it must be smaller contract sizes, right? So if you go, okay, how much smaller are the contracts? Let's say that the contracts are half the size, or 1/3 of the size, then it still should be a 4x increase in revenue from new customers compared to all of last year. And last year, I don't remember what was their growth rate that they grew, but I think that there's a very
22%.
legitimate, yeah. So I think that there's a very legitimate that they will surprise us on the upside, just going from sales funnel conversion rates perspective. But I agree that when they grow really big, a $4 billion increase in revenue, that's like 10 NHS contracts. That is, and you have to remember that the NHS is over 5 + 2 years. So it's not even that they're getting 500 million in the same year. So it's like 10 NHS contracts all recognized and delivered in full in 1 year.
Yeah, Vince, I think you're correct. I look, I think that the next 2 years, they could really surprise us with a huge influx as the boot camps take off. And we could say, and I think that's part of the reason why the stock is going up and not selling off, because I think people are starting to realize how much growth potential in the next couple of years there are. And I think you're hit the nail on the head with that.
Thank you. Thank you.
Can you share the screen, please, so that we can make
I'm not
the
seeing
experiment
Excel.
together?
Oh, this is the Excel. Okay, yes, go ahead.
Okay. Basically, this is the Excel, how it was set for the screenshot. I would like to make this experiment with you together. So what do you think are reasonable assumptions for the future in terms of growth, and then we go on the free cash flow margin?
I have a question, because it tends to be that these fantastic companies surprise on the upside when you look at the long term, right? Like if you look at Tesla, nobody thought that they would be as big. If you go back to 2015 and you would tell people that they will be doing 2 million cars a year and have the amount of cash flow and margins that they had, not currently have, then people would think you're crazy, right? And I think we can get into this trap that we cannot see how they can grow from 10 to 13 billion, but they might find a way at that point. Because just look at how much the company has changed just from like 2 years ago. We didn't have AIP, we didn't have Apollo, we didn't have so many things. So I think we should be ready to be surprised on the upside, even on the long term. But I also agree with the fact that the more pessimistic your assumptions are, the more risk you take out of your own investing.
Absolutely. And look, Artie could be right with these. Like, there's no question about that. He could be 100% right. I just I can't wrap my brain around with how many customers we currently have, how we get to a point where we're growing 5, 6, 7 billion. I mean, look, from 2023 to 2033 to 2034, that's $9.1 billion in year-over-year revenue growth. Like, the company is not even a third of that today with all these companies. I'm just wondering how we get to that point. I don't know that anybody can answer that question.
Well, Steven, that's exactly the point. If you agree with what you exactly said, basically you are not agreeing that Palantir is undervalued right now, because what you are implicitly saying is these assumptions are too high to justify the price. And this is true. Basically, the current price is already too high because it incorporates too high expectations. That's the problem I see. So that's why I wanted to make these experiments.
But Arnie, one of the reasons why a lot of people don't like discounted cash flow models is because the market doesn't work on a pure math basis. Otherwise, Amazon or Tesla would never trade where they do. Same with a lot of other companies. But you got to take investor sentiment and a lot of other things into consideration. I mean, if it was just pure math, Verizon would be significantly higher than it is today. Same with companies like Altria.
Absolutely, but that's why it is very helpful to assess how rich the current expectations are in the price, and then by knowing the company very well, as I think we are trying to do, then we can reason on the assumptions and trying to understand, okay, but how reasonable is this 30% to keep growing for so many years? Because that is a hard stick, and if you don't have a company like Palantir that can potentially produce new products, surfing a new wave, as Vince explained perfectly. Amazon, if you made a DCF back then, assuming that there would have been only a library company, you wouldn't have understood
you could do the
how
DCF
big the
today.
potential.
Amazon probably looks like it should trade for like $40-$50.
Well, but you need to be aware of that.
I think that's Arnie's point, right?
I mean, that's exactly my point. You need to be aware of what the current price implies. And then with your business understanding, you understand if there is actually substance to keep growing like that. Because, for instance, a company like, let's say, C3AI, I wouldn't expect them to be this good to reach these numbers. Why? Because by understanding the business, we see that they don't have such a strong business model to sustain these strong models. So let's, guys, do this experiment together. So before we said the growth is...
leave those. Do 2030,
Yeah,
2034 and do a scale down.
You can't don't just use an arbitrary flat number. I mean, that's bullshit.
Okay, so
what if you take 40% for next year, and then you go like 5% down each year, like 40, 35, 30, and then you...
Okay, so 2024, 40%.
And then maybe you scale down like 28.
Yeah, scale down a couple of percent year over year.
35. Yeah. Tell me when. Oh, okay, no. So
yeah, 30, and then 28.
25, 20, and then still 20.
No, I mean, I would scale down slower. So like 30, 28, 26, okay. and then 35. Yeah, 25, and then you stay at 25.
Okay. 25, 25. Okay. What the terminal growth rate? Let's say we are in 2034, and we say Palantir needs to put to have a number like a free cash flow margin. Sorry, a free cash flow multiple on top of the terminal growth rate.
I just want to know, like, are you going for what the potential?
Something's not right here. That last number barely changed, and you just changed all those numbers. Matt, did you see that?
Yeah, no, that's what I was going to talk about. But the thing that I'm trying, are you looking for what the potential could be or what a reality is, right? Because I also think that like there is a potential that it gets to this, right? There's not like, but I guess it's trying to be realistic in the assumptions is like, is everything going to be bright-eyed and bushy-tailed as you think it is, or should you build some safety factors into this? Like, are you just trying to pump the fucking stock, or are you trying to actually help people here?
I think Arnie is just trying to show people what is built into the expectations, and then everybody has to judge, like, do I think this is real? And then if they go like Matt, that this is very high assumptions, then maybe you shouldn't add at these prices, or maybe you have to find.
I think showing one model is going to give people the assumption that, like, oh my god, it could even be better than this, so I should put all my life savings into this company.
Actually,
I think you're literally just trying to pump the stock, and I just don't agree with how you're doing it.
Exactly the opposite, Matt.
No, Matt. Arnie's showing the aggressive assumptions. He doesn't agree with the DCF either.
Like his point is that like it's very high assumptions baked in, which makes your investment very risky. We were all buying at much lower prices, and if our chances, even if I don't know how to say it, like here you're max risk at investing here, because if you're just a slightly bit off on your assumptions, the stock price will not hit your price, and you will not have.
No, I mean, I understand that now. I guess I was just kind of curious. Like it made it seem like you thought that you believed what the 30% was.
No. I mean, this is exactly what I said. If you believe that these assumptions are too high, you're implicitly saying that this stock is too rich. And that's exactly the point of doing a reverse DCF rather than doing a normal DCF. And that's why I wanted to go together to say.
Okay, so if we don't do 30%, you're doing 25% growth, Arnie. Which number are you changing? Yeah, we'll do 25.
I mean, basically, it really depends on the growth you put, and the growth actually affects more
Let's
than
do
the
25 for the next 10 years instead of we did 20. Let's do 20. Let's be even more conservative. Let's do 20 instead of 30.
Okay. So
for the next
20
10
for
years.
2024. Okay, I always say 20.
Yeah,
Okay,
do it for
Palantir,
everything.
under the assumption of 25% free cash flow margin and a 3% dilution per year, which is reasonable in my opinion to be conservative here. Otherwise, we can also dilute we can also cancel the dilution.
The thing is that if they buy back stock, it's a little bit financial engineering, because then they can take out a lot of the dilution.
Well, potentially they can do that. So, but here, well, let's say both. Basically, with a 20% growth for 30 years, for 10 years, with a perpetuity growth rate of 3%. So assuming that after these 10 years, Palantir grows 3%. This is basically a typical assumptions you generally put after 10 years, just to say the GDP should grow around 2%. We say this company should grow a little bit more, and the implied assumption is 13 13x free cash flow multiple. So basically, what we see here is that Palantir, if it grows 20% for 10 years and has a free cash flow margin after tax, so this is already a quite rich assumption. Basically, the current the fair value is $10, and then now you see why some analysts have such a low such a low fair value for Palantir, because by changing 20% or 30% for 10 years, the assumption change dramatically. Let's say, basically, you move from having a company that is worth around $10 to around $18. That's why this exercise can be helpful, because if we see that the current price actually implies a lot of growth, let's say Palantir needs to grow 40% to justify a price, then you start having a problem, because you see, to get to a price that makes sense at $40, Palantir needs to grow 40% for 10 years. So basically, the higher the price, the higher the implicit, the internal assumptions of growth needed to be higher to justify the price. That is exactly what happened with Tesla. Basically, when it was on the top, the price was so rich that implied a growth of around 40-50% for 5-10 years. And then guess what? It didn't happen, so the stock crashed. And that is actually what also happened to Palantir back then in 2020, 2021, because people had models with these assumptions that were basically 40% growth for many years. Then the free cash flow margin, we put 30% going to 50% because it's cool. And then to justify the price, you need a $72 per share. And people were saying, this company is worth $70. Wait a second. If you put very aggressive assumptions in the model, then you are paying for a rich future that can't happen. So that's why, by trying to assess, okay, but the current price, $18 per share, what does it imply? And then we see that the current price of $18, $19 implies growth of being 30% per year for 10 years. Then we can reason, how reasonable is this? Because if Palantir can actually grow more than 30%, then implicitly we have a hint that is undervalued. If we see Palantir is expected under the current price to grow 30% for 30 years, and we believe, okay, there is no way Palantir can actually grow this much for so long, then maybe the valuation is a bit stretched.
That's not necessarily true. So what you're paying for today at a $19 share price is a market cap of $42 billion that has $3.3 billion in cash on hand that generates $475 million in free cash flow. That is growing at a current rate. And you're paying for the future growth because every investment is the present value of all future growth. And you're paying for assumptions. Let me bring my screen up, please. So I put 16 companies on here. Companies don't trade at a perfect discounted cash flow model. I put all different companies in here. Palantir is currently trading at 90 times their free cash flow. Tesla, and you even said Tesla's stock crashed, has a $672 billion market cap and trades at 181 times free cash flow. You look at companies like Microsoft. Microsoft's trading at 43 times free cash flow. Boring companies like Pepsi Cola is trading at 33 times free cash flow. Coca-Cola and Walmart trade in the low 20s. So when you're looking at a discounted cash flow model, and that's why a lot of people don't necessarily use them anymore, because it doesn't take a lot of things into consideration. For something like Palantir, you need to look at where you put this in there, where it's going. And if you think that Palantir possibly has the potential of generating $5 billion on an annual basis of free cash flow, there is no way Palantir is going to trade at less than 20 times free cash flow, which puts them at 100 billion market cap. When Walmart
that is what
trades
happened
over
last
20
year.
times free cash flow.
If you made exactly the same exercise last year, you saw that the current the price implied at a valuation of $7-8 per share was that basically you could buy the future for free. Right now, you don't buy the
You're
future
not buying
for
the
free.
future for free. You're paying $8 a share, which was a market cap of like what, $19 billion market cap. You're not paying free zero.
You basically got a business that could grow easily that 20-30%. Sorry, you could grow normally, but you had so much upside given the multiple expansion that basically you could grow. You could buy a becoming better future for free. Basically, the price at $8 implied Palantir would be a crap for 10 years. While
what
it
am
was
I
not
missing
true.
here? That's not free.
What do you mean that's not free?
It costs more than $0.
Costs more than $0. It's not free.
Yeah, but you were buying.
Okay. I'm not smart, right? And I also am not good at math. So let's just break this down, okay? If you were to ask me, do you think that Palantir is going to be more influential than some of these companies that are worth $150 to $200 billion? Or is it going to be closer to something like an Apple, a Tesla, a Microsoft, right? That's the rudimentary shit that I'm getting to, right? You could write these discounted cash flows and God knows what till you're blue in the face. But at the end of the day, the question is, do you think with what Palantir is starting to demonstrate today, they are going to be more valuable than an Intel? Are they going to be more valuable than, I don't know,
look at Salesforce. Salesforce is a $200 billion company.
Yeah, are they going to be more important than a Salesforce?
Probably the best example because it's a very similar application-based company, or an Oracle.
So the thought process is you're going to go from $43 billion to what? 120, 400 billion, 800 billion. That's where you start to recognize is like, okay, so and I think that the valuation that you're kind of giving it today, you have to look at it as, if you look at it from what you're talking about, Arnie, an estimated 11% return, basically for the weighted average cost of capital, everything like that. If you are investing in it in something like that, are you going to meet or expand upon that, right? So the thought process is like, to me, at what point do you think it's going to get to a $120 billion market cap or a $200 billion market cap? Or will it even go above a $200 billion market cap? And that's as simple as I'm trying to make it. To me, I currently see this as a guaranteed 3x from where it is today. I believe it'll get to a $120 billion market cap. I don't think it's necessarily going to happen in the next 5 years, but it might happen in 10 to 15 years. So to me, I think that that's a pretty reasonable valuation for where we are at $18. I think it'll easily get to about a $60 price target within the next several years. Now, if you start to think about what the potential is, right? Maybe Palantir starts knocking on some doors and you honestly think then, oh shit, it's going to have its Tesla moment where people are recognizing that it could get into the half $1 trillion market cap club, then yeah, maybe it'll start to trade at something closer to $100 a share. But that's still going to be something that I think either is going to take 2 to 3 years to get to that point and make people even realize something like that. But even still, you have to realize it's gonna take time. I don't think you can assume something like that with what we've been demonstrated today. I think you can start to feel that way a little bit. But this
So,
whole
Matt, do you think 42 billion is like today? I mean, the market went crazy with Palantir. Do you think it's just a lot of retail hype that's really pumping the stock to absurd levels?
I think it's reasonable. These companies that are trialing things go through ebbs and flows all the time. You saw the same thing happen with a lot of companies in 2021, 2022, where their market caps expanded to hundreds of billions of dollars, and now they're back down to $20 billion. Right. So I think that, and same thing with Tesla, right? Tesla went through times of expansion and times of contraction as well. Amazon did the same. You're going to see these things happen over the course of time where new catalysts come out that pump the stock and move it in the right direction that everybody wants. And then it's going to sell off because people either get greedy, they take their profits, they move to something else that's shiny for the year. And at the end of the day, I think that we're at a place where I think that it could get to $20 to $25. I'm not saying that it can't, but I think you're going to either get to a place where Palantir has to consistently deliver at an expanded rate, which we have yet to see, before it truly moves into close to something like a $30 price target or a $35 price target. Yeah. If they come out next quarter and they say, oh shit, we expanded customer count by 100% and we're starting to see revenue growth, kick back to 40% year over year, then that's something that might truly move it into a different direction. But for now, we're looking at, what was it, 20% or 22% potentially revenue growth going into 2024. I don't think that's going to.
I'm in Matt's camp on this, and you have industries that catch fire, people take profits, but you're paying for the present value of all future cash flow. Salesforce is a $207 billion company. They generate $7.56 billion in free cash flow. They traded 27.5 times free cash flow. So to think that Palantir is going to generate 10 billion in free cash flow and trade it 90 times that is crazy. I mean, can they generate 5 billion and trade it 30 times? Yeah, absolutely. There's traditional companies that trade it 30 times, but just going off a discounted cash flow model doesn't necessarily work, and that's why a lot of people don't use it anymore.
Well, no.
Companies trade on
under the same assumptions. You always get the same result. That's a basic of valuation. So if you calculate, like if you model the assumptions in a different way, but you have the same assumptions, you get the same result. So it's not that the DCF doesn't work. A DCF is hard to be precise for this kind of company, which is a different thing. If right now we would be able to see the future, having a crystal ball called Palantir, and plug exactly the right numbers into this DCF from scratch, then we would always have the precise valuation of what Palantir is right now. But this is not the case. We don't know the future.
If investing was just about math, it would be super simple. It's not just about math. There's so many other things that go into it. That's why people are paying 180 times for Tesla's free cash flow, because they believe that Tesla is going to grow so much, and it may. You are paying for the company's future free cash flow. That's what you're paying for.
Exactly. But if you are paying for too much future free cash flow, and that will not happen, then you have a risk, not on the company, but you have a risk on the stock, which is exactly what we are trying to share. So that's why if we believe that this 30% is too high for 10 years, then that is a hint, okay, we need to be careful, because the price already implies a future that is very rosy. And if Palantir can't really sustain that expectation, then there is a downside risk. And potentially for short sellers, this scenario is an appealing one, because at the right moment, as there are some skepticism that Palantir could deliver such a strong growth as the price implies, then you can be easily hit by short sellers. So this to say, I don't know what the future will hold. I would say at the current price, the expectations implied are already quite rich, and I need to be aware of that.
So I just want to say, I think we got lost in the... Yeah, I think we got lost in the weeds a little bit, because valuation is not a science, it's an art, and you can have different viewpoints. And I'm very curious, because I think all of us agree with the fact that the lower you buy, the more risk you take out of your assumptions. Like whatever, if your assumptions are based on free cash flow multiple or on a DCF, the lower the price you buy, the more chance you have of being correct. And I think what's a little bit special about this group is all of us have a much lower cost basis or average price of Palantir than at least I hope, than what the market is trading at today. And there's two things that make a stock go up. It's always a supply and demand, right? So one of them is you can have a lot more buyers coming to the market than sellers, or you can have the sellers just not wanting to sell. So for example, even if we think that Palantir is a bit richly valued at this point, we are all not willing to sell because we think that the company is a very amazing company that is going to grow very much in the future, and this alone can push the price up. So I'm just very curious, are you guys buying at this level? Would you be buying at this level? Because I think that that's more Arnie's point, that if you're buying at this level, you are taking more risk than when the stock price was lower. I think that's all he's trying to say.
I personally am not buying.
I have not been purchasing now. I wouldn't be opposed to it if I didn't have other things I was interested in adding to at the moment. But look, I would be willing to pay 90 times free cash flow today because of what I believe it is going to do in the future. But 90 times free cash flow is a very high valuation, and it leaves a huge room for error that if it doesn't deliver on those assumptions, this stock is going down. And look, I think that right now, PayPal is a much better valuation for me, and I am more interested in adding to my PayPal position than Palantir here. I also have a lot more Palantir than PayPal at the moment, but I wouldn't be opposed to adding here if I had what I would consider my full position of PayPal or some REITs that I'm still buying. Because I think REITs are going to come back very hard next year.
I was literally just having this conversation with a friend on the drive back home here, and he was talking to me about, one, he has like 30 shares of Dutch Bros, and I don't know how many shares of Palantir, and he's like, man, I really hope these things moon so I can retire. And I was like, well, I think you're going to have to buy more than that to be able to retire, but that's a different story for a different day. But I was just telling him specifically, I was like, yeah, man, I easily think with the assumptions today, assuming that Palantir doesn't dilute too much and they don't start buying back shares, which I hope they do, because that'll help with this assumption here. But I don't think you're going to lose money buying Palantir here at 19 if you're looking at a 5-10 year time horizon, right? I think in all honesty, you're going to get to a place where Palantir, I think, is well set from here in the next 10 to 15 years to be a 2 to 3x very easily. Right. I think that there's not a lot of risks associated with that. The risks start to come in where you think if it's going to be able to grow to a $250 to $300 billion plus market cap, I think that's where you have to start realizing, like, have they demonstrated that capability as of yet? I don't think it is. So going back to what Steve is talking about, if you're looking for something with more outsized potential returns, and it might be, that's the thing, is you have to evaluate the risk aspect of things and also the outsized returns. I'd rather put my money at this price for Palantir versus, say, a Rocket Lab. I think I would choose a Rocket Lab because I think that Rocket Lab has the potential much easier to have a 10x return from here. Yes, it's a little bit more risk, but I'm willing to take on that capital exposure risk for something that might generate me a 10x return. And yes, it might have more capability to go to zero. It all really depends on, do you want to see a red number or a black number at the end of the day in 5 to 10 years? And if you don't want to see any red numbers, I think you're much safer buying a Palantir, right? So I think it all just depends on what risks you're willing to take on. That's not just necessarily for a conversation that we're talking about with Palantir. This is just a discussion about weighing different opportunities as a whole, right? If you want to guarantee that you're probably going to retire a millionaire, buy the S&P 500 every single month and just like let it go, right? And that'll be something you worry about. You don't have to worry about it. You'll be okay. But the thing is like, if you're okay taking on a little bit of excess return, you might be able to, or excess risk, you might be able to get a little bit of excess return. And that's kind of what we're talking about here. So take that into consideration, because there's a lot of these companies that people on YouTube, even some people in this room might take and talk about. And that's not to say that they're wrong to talk about it, but they might have risks associated with them that might not end up going to the moon. I think a lot of times as human beings, we don't value risk appropriately, and we just assume everything is kind of on an even playing field and that the potential is always going to be there, and it doesn't always happen. And so for me, I think $19 is too much. My cost base is around $12.50. If it was below $15, $14, I was starting to write puts, I think, not too far ago. I would probably start writing puts again. But for me, I'd rather pick up Palantir here. And I also started picking up some other companies as well. But sorry, I'd rather pick up Rocket Lab. I meant not pick up more Palantir. Anyway,
Well,
sorry.
I think we
Speech there.
can
Real
all
quick,
agree-
thank you, Growth Stock Wiz, for saying bless you in the chat because he saw I sneezed. Okay, go ahead, Arnie.
I think we can all agree on the fact that the lower the price we pay, so the lower the multiples compared with the fundamental strength of the business and the projected growth, the lower our risk of actually investing in that company is. For instance, before we mentioned PayPal, and PayPal, I think it is in the opposite situation where Palantir is right now. PayPal trades at around, correct me if I'm wrong, but around or even below the 10x price to earnings, which basically implies that the stock says if this business keeps this level of earnings, it is fine. Basically, the price is so depressed that the implied assumptions is this business is not going anywhere because it is already a dinosaur and now it sucks. However, if PayPal actually keeps delivering and finds a way to actually increase the free cash flow, the earnings very sustainably, then that price actually makes no sense because you are basically buying a future that is rosy and you are not paying for that. You are paying for a thing at a price as if it was going to stay stagnant forever. So which is exactly the opposite case we have with Palantir right now, because the price is rich, potentially the things can go really better than the price is already implying, yet we need to know that the assumptions implied in the price are already quite rich. And we can see it, for instance, from another point of view. Before we mentioned the free cash flow, here on CoinFin, they don't have the EV to free cash flow, they have the EV to EBITDA, which for a company like Palantir having no capex, we can say is a proxy. It's not precise, but is both in the ballpark. And we can see the comparison with Palantir, ServiceNow, and Snowflake. Snowflake is the blue one, and ServiceNow is the green one. I consider Palantir is a little bit of mix of the two, because in terms of business structure, it is very similar to ServiceNow, Salesforce, this huge B2B subscription revenue business, while in terms of potential growth, Palantir is closer to Snowflake, that it has a business structure that potentially can grow much faster than 30%, potentially. And here is the comparison with Palantir and the other two. I like to compare more Palantir against the ServiceNow, because so far ServiceNow grows 25%, 30%, while also having a free cash flow margin of 30%. You see, is very similar to the numbers of Palantir. Yet Palantir last year was trading at a crap level compared with ServiceNow. It even reached 18x EBITDA, while ServiceNow was always in this range, more closer to 30. Right now, the EV/EBITDA, so we can consider it a proxy of the free cash flow multiple of Palantir, is around 52 versus ServiceNow, which grows more, has a better free cash flow margin, and is already more established than Palantir. So the valuation right now tells us that the price of Palantir implies that Palantir could grow better and with better free cash flow margin than ServiceNow, which right now is not the case yet. Can that happen? I would say yes, absolutely. And actually, that's the core thesis why I'm invested in Palantir. I just need to be aware that when the price already incorporates this future growth, I need to be way more careful. If Palantir, for a stupid reason, what I called a stupid crash, maybe dropped here, let's say at 20, 25, 20x EBITDA, then I would be extremely happy to buy, because basically I would buy a company that can deliver way better returns in terms of revenue, free cash flow, and so on, than what I'm paying for. And that's the definition of a bargain. Right now, I would say Palantir is expensive, and I see reasons for why it is expensive.
Yeah, it's exactly the point that I was making. None of us are selling. So that's the two things that you need a lot of
Yeah, I
buyers.
don't want the tax consequence.
Exactly.
But I just want to put this into the room. I mean, sorry to cut you off, Vince, but like, I honestly think that people need to take a step back and just take an honest look. I just looked up the total market cap of all the companies in just around the world. There's 7,900 companies that are publicly traded. 48 of them are $200 billion or more. So that is a 0.6% of all the companies in the world have a market cap above $200 billion, right? And if you start to look at anything above $400 billion or $430 billion, where this is a 10x from here, right? Assuming share count stays the same, you're looking at 16 companies, right? So do you honestly think that you can predict a company from where it is today to be in the 0.6% of market caps in the world, right? I think that is very, you have to start to realize, right? And I think a lot of people are kind of dragging me in the chat box, I think, because I'm not being a complete bull here. And I'm not saying I'm selling the stock. I didn't pull an Arnie. But, you know, at the end of the day, I think you just need to be a little bit more realistic and say, you know, I think this could easily be $100 billion company. And I think that that's a reasonable valuation. To start assuming that it's going to be a 10x, right? There's only 16 to 20 different companies in the world right now that would be rated above a $400 billion market cap. So you just have to start to take a little bit of reality. And I'm not trying to shit on the stock. I love the stock. I use the company every single day at work, right? But I'm trying to help people not hype up and get ahead of themselves and look at the numbers for what they truly are.
I mean, that's something really important right there, because you look at Walmart. Walmart has a $447 billion market cap. They generate $20 billion in free cash flow. So if Palantir generates $20 billion in free cash flow a year, what should their market cap be? Should it be more? Should it be less? I mean, it's so hard, and so few companies ever reach that point. And, you know, there were some comments about PayPal there, because I mentioned PayPal. PayPal has a 60 billion market cap. Palantir is a 43 billion market cap. Palantir generates 475 million free cash flow. PayPal on the trailing 12 generates 3.1. And when you get Q3 of last year out of there, and you bring in what they're projecting for this Q4, they're going to generate 4.9 or 5 billion this year in free cash flow. So if you are buying an entire company, would you rather pay 43 billion for Palantir and generate 475 million in free cash flow annually, or would you rather pay 60 billion for PayPal generating 5 billion? It's a no-brainer. And it's a very hard thing. Palantir could do very big things. I think they're going to. But do I think they're getting to $400 billion? It's a tall task. I'm not saying it can't happen, because things can ride crazy waves, and Palantir could ride a crazy AI wave. We could see NVIDIA, AMD, and Tesla push AI up so much, and Palantir push it up, that they get huge bids the way they did in the dot-com bubble. But do they stay there? I mean, that's why you got to look at some things in a realistic thing. And something like a PayPal, they're buying back $4 or $5 billion worth of shares every year now. And they are consistently growing earnings. Their earnings are going to grow 30% in the next 2 years based on more than 40 analysts. So Palantir's not doing that right now, those types of numbers.
Yeah, I think a lot of this hedges on, is Palantir going to be able to show the growth to justify what Arnie was showing in his model, which is 30%. And I don't know. I mean, AIP's got to really take off. Nobody knows.
You see, I
Nobody
just want to
knows.
say,
The next couple of years are going to look really good, but how do they generate 5 to 10 billion in annual revenue down the road to get to those? And then the other thing is trading at a 30-time free cash flow multiple is not out of the question down the road when they mature. And if they are generating 5 billion in free cash flow, that's 150 billion market cap. That's completely feasible. It's just coming up with 10 billion in free cash flow a year. That's not many companies make that much free cash flow.
Well, that's
I just want to
exactly
say
problem.
I just want to say I really appreciate in this community that we are not just like pumping the stock. We are like very transparent both on the good and the bad side of Palantir, because for example, there is a certain percentage of the people who cover Tesla where everything is a good news. Like if Elon Musk goes mad, then they spin it into how this is a good news because he's a mad genius and blah blah. And we are definitely very based on this show. And the reason why I think that Palantir has more in it is because, as I said, you have to have people buying the stock and then people willing to sell the stock. And while we are all saying pretty much in all our different ways that buying Palantir at this price point, you will probably make money. The question is like, is it still going to be 18 or 19 or 20 in the next 3 years? So you could have made better money elsewhere. Or it's going to be, $30, $40, $50. And we are not selling. So I think that we are all speaking with our wallets. And the fact that we are not selling, it means that for people to buy from us, they need to give us a higher price. And this is why I think that Palantir is going to go in the near term future more up, because the bulls that are there, they agree that it's richly priced, but they don't want to sell. And there's a lot of people coming to the stock. We are soon joining the S&P 500. So I think that the near-term projection for the stock is up.
And Vince, that's very important. And look, Palantir could double next year. There's nothing that says it can't. And you got to remember, there's $5.7 trillion sitting on the sideline in just money market accounts. If the Fed pivots in June or July, which is when the most probable chance of seeing a Fed pivot is, based on CME Group, early as March, eventually people are going to stop rolling money in money market accounts or CDs, and that money is going to find its way into the market, some of it. And if Palantir is part of the S&P and people are buying S&P funds or total market funds, some of that money is going to go to Palantir. And part of the reason why a lot of people think that there's going to be a big bull market in 2024 and 2025 is because of Fed cutting rates, people not getting 5%, 5.5% on the risk-free rate of return in the short term, and they're going to look to deploy capital into the markets because CDs, treasuries, and money markets are no longer attractive, and they're going to go after tech companies. And that could cause a huge upswing in the market where a rising tide lifts all boats, and that is completely feasible. All I'm saying is that at some point, numbers matter. And it's almost impossible to project out, even to where I did in the article. Like, I think I took a halfway conservative road, and it's a lot of assumptions. And I said it's a lot of assumptions that I put in there, but they're the assumptions I'm looking at to justify holding it and not taking profits now, because I believe that has the potential to do something like that.
Let's get Arnie with the last word, and then we'll be done. Arnie, go ahead.
Well, I think it is always difficult, but probably the most important thing to always keep in mind that the stock is not the company. The company is what produces the growth, generates the free cash flow, and the price is the opinion on reflects the opinion on how much stronger the company would be in the future. So our job as investors is always to try buying the strongest possible company, which I think we all agree on the strength Palantir has and can really develop. Our job as investors is basically paying less, or at least trying to pay less compared with what the price tells us. You make a bargain by definition when you buy something at a lower price than it is actually worth. And a company, it is actually worth the sum of the future free cash flow. So we just need to be careful when the price incorporates rosy assumptions, because implicitly, even we are not telling that, but already by holding the stock right now having rich expectations, we implicitly crave for the growth to be higher than these famous 30%. Now, I personally believe there is enough substance to actually achieve that. That's why I keep the shares I have, but especially driven by AAP. Like AAP was that factor that made me okay. Maybe these numbers can be achieved okay, now I see enough evidence that makes me confident that these numbers can be achieved. Yet, I believe we always need to be careful because let's say Palantir right now, if it traded at $10 per share, I personally think it would make no sense. There is even an analyst saying Palantir is worth $5 per share. And at a $5 per share, basically you would buy a company growing that 20-30% with this 20-30% free cash flow margin at a price of 15x free cash flow. Basically, you buy a money printer machine for the price of a trash company. That's what truly investing is, trying to spot these moments. So far, as I mentioned previously, I think Palantir is expensive, but it's expensive for a reason. Right now, there is a lot of confidence that the growth could accelerate and Palantir can surf this secular trend. And as the story evolves, then not only the numbers are actually produced, so imagine the model that we showed previously, what it was 2024 projected, then it becomes actual, and you keep rolling that model into the future. So absolutely possible that the growth could be there. I would say just be careful when you pay for high growth, because the higher the yardstick of the growth implied in the price, the more you need to be right. Otherwise, you just risk of losing money. And potentially, at this price, there is already the risk of Palantir being stuck for a while. But as the story evolves, there is more confidence in the AI trend, maybe the numbers of Palantir improve, then you can have a further expansion. And that's what I personally think it will happen. I don't encourage anyone to think it will happen.
Let's end it on this question. I think this will be a fun question. Do you guys think, because of the run-up, anyone from management is going to sell shares? I'm going to go on a limb and say yes. I think we're going to see some insider selling coming up in the next couple of weeks. What do you guys think?
It's guaranteed just based off of just normal sells for just compensation, right? I mean, those guys.
No, I'm not talking about that. I'm talking about on the open market. One of the insiders are like, $20 is crazy, I'm selling. Like, do you think that's going to happen?
I think that we don't really understand these people. This year, I came into a situation. I own a real estate company in Sweden. I've been working 10 years in this company, and we actually faced at one point very real bankruptcy fears, right? And I realized, like, oh my God, if my company goes away, then I didn't secure anything for my family. I don't know how I will like feed my kids going into the future. And then at that point, I started thinking, if there was a way that I could get some money off the table, like to just, secure, because I have put in 10 years of my life into this company. And then if it would go away, like it starts to become a very bad risk reward, And I think that we don't see this when we talk about insider selling, that some of those people are sitting on millions and millions of dollars of wealth that they have worked, I don't know how many years on. They have their own life. They have kids, they have wife, they have their own personal needs. So I think that when they are selling, when the price runs up, it's like I start to understand it more and more. I just want to say this.
That was the case when, for instance, I remember Xiam sold a lot, almost at the bottom, and that was not a sale driven by taxes, but it was a discretionary sell.
It must have been, because he was.
It must have been, yeah.
Yeah, because he knows a lot more about the company than us, and he is working. I think you guys remember when we were asking why he was moved to the CTO position, and we were speculating that it's because of the specs, and I think it was because he was put on the AIP, because it seems like he's the one who's running AIP and always doing the announcements, and so it's like he's one of the main reasons why we are here in the first place. And I think he was getting a real itch to buy a yacht, or I don't know, he has a beautiful girlfriend that he needs to, a trophy wife that he needs to keep or something. And then at a certain point when you're talking about many millions, like some people don't care. They just it doesn't change their life so
That's
much.
what I'm saying. If the conclusion was that if Palantir's not growing at 30%, the stock's really overvalued right now, or it's at a nice premium, I think some insiders are going to take some profits before Christmas. I feel like it might happen. But
yeah, but why wouldn't you?
we'll
I mean,
see.
think about it. You have people that work there 10, 20 years. That's been part
I'm
of
not
the
judging. I'm
conversation
just asking.
that they haven't been able to
That's all.
sell until the company went public 2-3 years ago. And you don't know what anybody's situation is. Maybe somebody's buying a yacht, like Vince said. Maybe somebody's buying a vacation house. People have expenses. People sell for all different reasons. I mean, insider buying and selling is a good thing to look at. Obviously, it's more bullish when insiders are putting up their own money and buying. But there's only one reason you buy a stock, and there's many reasons you sell a stock. And I'm looking more at the company's fundamentals and where I think it can grow. And look, I think the valuation could be stretched here. But for me, my own personal, so a bunch of people asked what my price target is. I'm not going to give one, but I see the company doing better over the next 5 to 10 years. And I plan on holding this for the next 5 or 10 years. So I'm going to add when I feel it's worth it for me to add. And I have no interest in selling my shares. That's why I'm not writing cover calls on it, because I don't want to get my shares called away, because I think it's going to be a lot bigger. And look, the money I have in Palantir, if it goes down, I'm not losing sleep over it. I mean, that's the other thing. You need to invest with a plan and make sure you don't overextend. Certainly, I'm not a proponent of buying on margin, and certainly making sure that if something doesn't go the way you think it's going to go, that you're not putting yourself or your family in harm's way. Like, that's the most important thing. Too many people get overextended.
Well, going back to the insiders, I believe there will be two kind of people, as there will be two kind of investors generally. Since basically we are approaching the levels of the meme period where the valuation was obviously overstretched, I think at this point you will have these two kind of people. On the one side, you will have people like us that are willing not to sell. They see these story unfolding in the right direction, and we are confident in the future. We can agree, disagree on the stupid number, but if we are not selling, basically, it's because we are confident in the future ahead. And this is one category. The second category is, and I would say also insiders, all the people that bought or maybe received shares without really understanding what was going on. And they missed maybe the opportunity to sell those shares at a profit back then in 2020, 2021, when the price was high. They are out now after 2 years of sufferance, and they could see Palantir getting back to these levels as sort of a relief. And psychologically, it makes almost a sense to say, okay, I suffered, now I'm back again to my break-even point. Now I sell because I got traumatized once and I don't want to get another trauma. So I think we'll see some, I know it sounds obvious, but we'll see some volatility now between these tensions. People who are actually very confident and vote with their own pockets, as we do. And those other people that are just craving to get out, to get some safety net because, oh, finally, I'm at break-even, finally, or I see the green. I want to be sure that I don't get that trauma again. And I think this can happen also to insiders. I would say we look at the insiders as people that know everything on the company, the fundamentals, but the reality is that most people just do their job. They don't want to spend too much time, energy into thinking about the financials, everything that happens to the company. So also from insiders, I believe there will be some employees willing to sell shares that after these 2 years of downturn. So
Mitt, I'm going to ask you a question.
All right, I'm gonna answer
Are
this
you
question. Then we
worried
got to
about
end it.
Apple with
Now we're
Tim
3.
Cook selling shares? I mean, they just printed 96
No, I
billion
don't.
in profit. I mean, it's
I don't give a
people
shit
sell
about Apple.
shares.
No, I don't care. I don't
You
care.
don't, yeah, but
I
you don't
care
care.
about
But it's 7% of the S&P. It's the largest company in the market. CEO
Apple.
selling
I'm not buying
shares.
Apple, so I don't.
No, I
it's
get
not.
that, but I'm just saying the CEO is selling shares. Yet they generated 98 billion in profit last year, 96 billion in profit this year. I don't think people are worried about Apple because Cook is selling.
Well, it's a different dynamic.
Again,
in my
I didn't
opinion.
say yeah, and I wasn't judging on if it's good or bad. I just asked you guys, do you think they're gonna
Yeah,
sell?
no,
That's
I'm
all
just saying. I
I
don't
think
think that it's the end all be all. I mean, people sell shares.
I don't
They
think
earn that
Carp
money.
will sell.
Or to the comp.
I think the other guys will do, because
Yeah,
Carp at this point it's like the moment of the truth. Like Carp has been working for 20 years as a founder to reach this point, and I don't think he would want to lose
all right,
his
Matt, last
personal.
word. Then we gotta end it.
for sure. Yeah,
Go ahead.
just 1 point or 2 points, and they're all on topic. So, I think with this and the recent movements and Sean going to CTO and the continued leadership being as it is, I think there's going to be some people in the company that have been around long enough where they're saying, you know what, I want to be in the big seat. I want to be CEO, and doesn't look like it's going to be on the path for me here at Palantir. And I see that all the time at many companies where, unfortunately, you have people that might end up in the big chair, and just based off of succession planning and just how things go, they don't end up there. So in that case, some people might be selling just to set themselves up for either creating other companies for themselves and creating a venture capital fund, or however you see fit, right? Like what Shamal Palihapitiya did, right? He was probably thinking he might have been on the path of CEOship, and he had a lot of Facebook shares that he eventually sold and started doing with what he did with those. So there's that piece of it. And I think another piece is, I saw somebody in the chat, I just want people to recognize this. Somebody was talking about how Palantir went to $40 a share back in 2021, but there was only 1.5 billion shares outstanding at that point. We've now increased the share count by 700 to 800 million since then. And so the market cap back then was only $60 billion versus the $43 billion we are today. So keep in mind, share-based compensation is what really impacts that. It's why people talk about it quite a bit. I think one thing that would really turn me around a little bit with respect to the stock going into a much more positive direction is if they actually do start offsetting the amount of share-based compensation by doing share buybacks in the next year or two. I think that they're going to be generating enough cash flow from operations to nearly offset at least a portion of that to help slow down. And eventually, once they grow, several years down the road, they'll definitely have enough to fully offset that as they continue. And if that's the case, Arne, you had that 3% growth of share count, going into the future. That'll have a huge impact on what the current price would be with your reverse discounted cash flow. If you were to make that 0 or even negative 1%, I mean, that would be huge, right? And I think that that's why Google will see such positive growth into the future, not necessarily because of earnings growth year over year, but EPS growth due to share buybacks. And I just wanted to throw that in there because people were
just
chatting
to
about it.
synthesize, basically, the real risks are the growth to stay strong enough to sustain the price action, and the dilution basically being marginally lower going forward, because otherwise you can grow a lot, but if the share count keeps increasing too much, basically all the value goes to the employees and not to the shareholders, so not to us.
Okay. This is a fun debate on valuation. It'll be fun to see what the comments are. And yeah, well, people will say.
Matt Money's going to 0 in the comments, man.
Certainly. All of us.
Well, this is what happens when a stock goes this high. I mean, this is what every Tesla community, they had to debate at 290, at 400. Was it overvalued? Right? Like, this is what happens.
But a lot at the Tesla community keeps saying that like whatever the price, it's always undervalued. And I really like that. I really like that this community is very based.
I think we made a great point before.
2,000 points away from its high. So if you believe the NASDAQ's going back to all-time highs in 24, 2025, Palantir is going to ride higher, most likely. Same with a lot of these stocks. I mean, market doesn't act realistic sometimes.
I mean, paradoxically, here we are debating because maybe the stock is too high compared with the real fundamentals. Basically, exactly the opposite of what the Tesla community tended to do. Because even at the highest top, they were saying, "Oh, he's undervalued." Oh, no, wait a second. So actually,
Tesla's the
good to have this
greatest.
debate.
Don't get Steve started on Tesla. We got to end this. We got to end this.
No,
Steve will go on
Tesla's
for hours.
the greatest automobile company. It's a phenomenal company. The problem I have with the Tesla community is that
No one asked for your problem with the fucking Tesla community, bro. We have to go to sleep. Like, no one cares. No one gives a shit. It's up. You don't have it. You missed out on it. Don't miss out on Palantir, Steve. Goodness.
I'm a shareholder of Tesla. What are you talking
Oh, your
about?
wife has 3 shares. You're not a shareholder of Tesla.
My
Anyway,
wife is a shareholder that makes me a shareholder.
all right, that's actually cute. That means, yeah, you love your wife, I guess.
Sign a prenup.
Thank you, everybody. Okay, make sure you sign a prenup, everybody. Thank you guys for watching not Daily Palantir, Palantir Weekly number 99. We had a good panel with us. Everyone's Twitter is in the description. If you're not on Twitter, make a Twitter account. If you care at all about Palantir, it's probably the best resource in the world to get Palantir updates. Everyone's Twitter is in the description. And if you are on Twitter and don't follow anybody, then please make sure you follow us on Twitter. That's it. We'll see you guys next week on episode 100, and we'll see where the stock is 10 days from now. Thank you, everybody.
Later, everyone.
Thank you. Bye-bye.